Hey guys, it's Jack. Today we're going to be covering the top 10 mistakes you can easily end up making with Vanguard that will cost you money in the short term and in the long term if these mistakes are unnoticed and you're not careful. Now, Vanguard is a relatively easy platform to use. There's not a lot on the surface that can go wrong with a set it up and forget it type of broker. But as a beginner, there's so much to learn with investing, so much information you have to absorb, and therefore a lot of these mistakes can slip through the nets and end up costing you money. But hopefully by watching this video, you'll be equipped to not only save yourself some time and money, but also be more relaxed and less worried about your investments. Now, if you had been buying some funds on Vanguard, such as the S&P 500, you might be missing out on some very clear opportunities, and these opportunities are to lower your investment costs. See, some of the very same funds you see on Vanguard will in fact cost you less if you buy them on Trading 212 and on Free Trade. And I'm not talking about alternative funds here. And you might be thinking, how is this possible? If I'm going directly to the source, I'm going directly to Vanguard, surely it's going to be cheaper. No, because the key to remember is that Vanguard charges a yearly 0.15% fee. No matter what fund you end up buying, just for having an account on Vanguard, you'll be charged 0.15% just by being on the platform. Now, the good thing about this fee, if there is any good thing about fees, is that the maximum charge is £375. You won't be charged any more than that so long as you have the limit of 250k in your investment account. However, you can just basically avoid this fee altogether by buying on Free Trade or on Trading 212. Here's an example of how it will work. Let's say you had 40k in your investment portfolio, all in the S&P 500 ETF. You'll be paying an account fee of 0.15%, which is equivalent to 60 quid a year. Free Trade does not have a percentage ongoing fee, and it is free to hold such funds. Now, if you do get the Free Trade ISA, you have to pay £3 a month. But with that, it doesn't matter whether you have £10,000 in your investment portfolio or 50,000. The amount you pay will stay stagnant, the same, because at the end of the day, there is no percentage charge. Now, obviously, you cannot buy some of the proprietary funds like the Life Strategy on Free Trade, but it's definitely worth buying the funds you can buy at a cheaper price. Now, another thing to remember is that you must store some cash in your Vanguard portfolio, cash that you won't touch. If you don't have cash in your investment portfolio, I guess an account, Vanguard have actually stated that they will sell some of your investments off to cover their fees. Now, obviously, if your returns are negative at the moment because of a market downturn or any other situation, you don't want to be selling your shares at a loss. So I always have some cash to cover that amount and any other fees that Vanguard may charge, just in case. So that's the account management side of things, but there's a lot of mistakes you can make when getting in and out of a trade. The first thing is that if you're buying an ETF like the S&P 500, you have two options. Either you can buy at the next available price or at the live price. You never almost want to be getting the live price option. This will cost you an additional $7.50 a trade. You might be thinking, live price or additional price, what's the difference? Could I be getting a better return if I go for the live price? Well, the answer is almost no. The way ETFs are designed is that they're priced twice a day. So when you do the next available price, your order will be slotted in one of those prices. For the live price, that will cost you $7.50. You can alternatively use Vanguard's quote and deal service, which will get you a price and your order fulfilled quickly so you don't have to wait. I personally wouldn't recommend you go for a service that will cost you more money unless there is a massive drop in the market like a flash crash or something and you really need to invest before the market does eventually go back up. But even in that circumstance, a couple of hours difference isn't going to make much impact to your bottom line. Now, obviously, what's been mentioned so far is the platform side of things, but personally I've seen the bigger risk to people's investments is actually themselves. In that sense, another mistake beginners make is not setting up their direct debits properly on Vanguard, so the money is automatically taken out for them on a specific date. What works well for me, and it might work well for you as well, is setting the direct debit date the same as your salary date. So as soon as the money is coming into your account, it's being taken away by Vanguard. This works well because in your mind, you never see the money. Now, obviously, you're going to be less likely to go out and spend it on some random stuff. But most importantly, the most important aspect to this is that you're less likely to let FUD take over your investment decisions. Now, if you don't already know, FUD stands for fear, uncertainty, and doubt, which there is no shortage for when you are in the stock market, when you're a stock market investor. If you don't have an automatic setup and you're planning to go ahead and do a manual sort of transfer and then invest that money, you're going to be exposing yourself to the whole thinking process. Should I invest? Is the market going to crash? Yeah, I might as well just wait for the market to crash and then invest. And you might have that waiting and procrastination period for a couple of months. And in that time, the market has gone up 30% and you've missed out on all those gains. The more you can remove yourself from the process, I find it to be better. Now, another problem a lot of beginners face is buying up funds, thinking how much of a fund shall I buy? Now, one thing you do need to remember is that Vanguard do not offer fractional shares like the S&P 500 or the FTSE, which is a massive problem because one, it makes it more confusing on how much of each fund you should buy. The second issue is that the money you receive as dividend may not be enough to really reinvest and buy that specific fund again. So it's just might be sitting in your Vanguard account as cash. And the more money you have sitting as cash, the more it is missing out on returns with inflation eating away at it. As a solution to this, what you could do is buy Vanguard's life strategy funds instead. These funds can be bought in fractional pieces, unlike the S&P 500. So you could buy as much as you like every single month. However, where you end up buying, what you mustn't do is trade these funds. What that means is buying them, holding them, and as soon as they go up by a few hundred quid, you sell them immediately and realize your profit. The problem with trading these funds is that you will incur a transactional cost every time you make a purchase and you sell. The second reason is, the more important reason, is that you cannot predict the market. If you sell and it does go up by a certain percentage after, you missed out on some gains there. The same can really be said in a market downturn. If you let your emotions dictate your investment decisions, it will seriously affect your overall returns over a long period of time. So in that sense, look at Vanguard's risk levels and pick the funds based on your personal risk tolerance. If you cannot tolerate seeing your investments go down by 30% or more, go pick a fund with a higher bond percentage. Nothing is guaranteed, but with certain funds, you can lower your risk as well as your reward. If you're wanting to increase your returns, you might want to just change the way you're investing. See, there are two main investment methods: dollar cost averaging or lump sum investing. Dollar cost averaging is when you are spreading your investments across a period of time, let's say on a monthly basis. Lump sum investing is, as the name says, just chucking it all in as a lump sum. According to actual research that has been done by Vanguard themselves, lump sum investing is actually the more profitable way to invest than dollar cost averaging, simply because of the fact that historically the market has always gone up, exceeding the return of cash. So by putting your money to work, it takes the full advantage of this fact of the market growing. Having said this, I do the opposite. I do dollar cost averaging. There's a lot with emotions and psychology which may play into your investments, and I find that by spreading your investments on a monthly basis allows you to avoid the huge regret if the market does take a downturn. A lot of money in the stock market is actually lost when people sell their investments because of such downturn and they just want to take the money out because they're scared. If you hold out, historically, you will do quite well. The market will eventually recover. I find that dollar cost averaging will make you less inclined to sell and more inclined to hold your position. Obviously, this debate is only applicable if you had a chunk you could invest in the first place, like a bonus you might have got from work. If you are investing as soon as your salary is coming in, then you're naturally going to be dollar cost averaging. Now, whatever method you end up selecting or falling into, don't make the mistake of looking at these funds on a monthly basis and changing your strategy accordingly. You can easily confuse yourself and it might put you off from investing altogether, because you might be thinking, this is too complicated for me, I just don't know what to do. Is this right for me or not? The whole point of something like the life strategy fund is that it takes all the noise from investing altogether, and all you have to do is put the money in every single month. I only invest in one fund on Vanguard, and that's the S&P 500. The reason is that it's perfect for my personal risk tolerance. You have to pick funds that are perfect for your own risk tolerance. Your investment strategy will change throughout a period of time. If you're more close to retirement or having a big purchase like a house and you need the money, it's definitely worth switching from the Life Strategy 100 fund, where it's all in equities, to something like the Life Strategy 20% fund, which is a lower risk fund. If you are an investor in the Life Strategy fund, you might also want to change your platform to interactive investor after you hit around 80k in your investment pot. Unlike Vanguard that offers a percentage platform charge, Interactive Investor charges a fixed monthly amount regardless of your size of investment. So really, you're better off paying a £10 a month charge to Interactive Investor regardless of your investment size, rather than a maximum charge of £375 a month on Vanguard. If you do count yourself as a life strategy fund investor, especially the Life Strategy 100, you might also need to be aware is that the Life Strategy has a high exposure into the UK market. Around 25% of the underlying assets you're going to be holding in the Life Strategy is going into UK stocks. Now that's a really high number, especially if you compare the UK's total stock market value compared to that of America and other countries in the world. Now the risk to you is that if there was an event, political or otherwise, that was isolated to the UK alone, at least 25% of your fund will suffer from that. The severity of impact would obviously depend on the event, but it's something to bear in mind, especially if you're investing for diversification. And if you are counting yourself as a diversification investor, then it's probably better for you to look at the global all cap index, which puts the allocation to the UK at just 4%. Now, although Vanguard is a great platform, I do not plan to hold a large chunk of my portfolio in Vanguard throughout my life. It's not only because of the fact that I can get lower fees somewhere else. It's because of one thing: platform risk. Just like investing in shares, you might get a risk that you might lose some money. There's also an individual platform risk. What if the platform you're using goes bust, or there is an accounting error which puts your investment at a greater risk? Granted, Vanguard is a well-established platform and the likelihood of this happening is relatively low. Nothing is guaranteed, and I'd rather put myself in a position where I'm not focused on one broker alone. If you do spread your money out and an event were to be occurring, then you will be still put to inconvenience, but you'll be less stressed overall because it's not like all your investments are tied to one platform alone. If you did watch this video to the end, please do leave a comment. Let me know your thoughts, questions, anything, feedback even. It tells YouTube that this lad's video wasn't too bad and it will push it further. While you're there, if it's not pushing it too much, please do leave a like as well. Anyway, thank you so much for watching and I'll see you in the next one.